Hi folks, welcome to the video. Do read the disclaimer. Today we are going to discuss one of the most important lessons in stock market history, and that has to do with the Japanese stock market. The lesson that we want to learn from here and apply to Indian conditions is basically to help condition your mind that anything can happen in the markets. It is not like, this event happened in Japan and hence that was an example of Japan only, and it cannot happen anywhere else. It certainly can happen elsewhere, and we need to draw lessons from such past history, learn from history, and apply it in our future. That is the intent of the video. So it's a history lesson, but the knowledge that you'll gain out of it could be used in the future in your journey. So the title is Japan's 35-year breakouts, what Indian investors must learn from this. So Japanese markets, you are very familiar, those of you who are also looking at charts, has recently just broken out of the 1989 December peak, uh, briefly earlier in 2024 and now in August 2025. This entire journey of last 35 years, imagine that somebody was born in, let's say, 1970, just like myself, and by 1989 or 1990 they were in either starting a job or late years of college, etc. That's when you would normally start taking note about investing or economy or so on so forth. Imagine that person starting out with a decade where the markets never went up. Imagine that you were starting out your career, you are doing some job or business or whatever it may be, and you're investing and your money is just going down. But for 10 years, 15 years, what will be your incentive to allocate to the equity market? Nothing, basically. When you've not seen any success in 1 year, 2 year, 3 year, 4 year, 5 year, 10 years, why will you even bother about the market? So when such an event happens, it creates lost generations, a generation or two which does not believe in the market at all, which currently is the opposite in Indian market, where even after the child is getting born, there is a sip being done in the name of the child. That's the kind of contrasting point of view I want you to think about. So entire generation and two wiped out in this period where people are saying, why should I go to the equity market? Anyhow, let's go back to the very start. So uh, after World War II, from 1949 to 1989, Japanese economy grew very, very strong, and US was USA's ally, and there was a lot of business happening. Japan was exporting big time to the US and rest of the world. So 14.5% CAGR is what Japanese market was able to achieve over 40-year period. And you can see that it was going up gradually till 1983, and then it hit a hockey curve, which took it from somewhere near 6,000 in 1983 to 42,000 by 1989. Imagine 1983 is 6,000, and you are at seven times more in the next 7 years. Seven times in 7 years. Is it even easy to imagine that? Imagine today Nifty is 25,000. In the next 7 years, if we reach 1,75,000, that's the kind of crazy jump that the markets had there. And the jump was not without reason. Japan became the factory of the world, uh, second largest economy. You can see 1980s how rapidly the nominal GDP of Japan is growing along with US, and China actually started much later on, from late 90s, but Japan was right there, um, along with the US on this. And this economic success led to a historic rise in asset prices. Land became one of the key components of the rise. So you want to note that whenever an economy will do really well and stock markets are doing really well, land will not lag it. Land will go along with it. So land in 1972, which was worth, let's say, 50 uh, whatever units you may say, and by 1990 it was at 400. So about 8x returns in land prices in less than 2 decades, which for land prices was fantastic. And Japanese land became so expensive that at one point of time, the entire Tokyo's net worth of land, if one were to calculate, was bigger than that of entire US's land. It became that extreme. And a small park in Tokyo was worth more than the entire state of California. So real estate went mind boggling, stock market went mind boggling, price multiples of 60 at that time in those decades where price multiple of 15 was also considered to be too high, and it was just mania all over the place. And it was basically like, iron is already hot and you are just waiting for a strike, and the collapse got triggered. Basically the market fell under its own weight, and there were some triggers which caused it to fall under its own weight. So the first trigger was the Plaza Accord. What was the Plaza Accord? Basically, in 1985, when the US wanted to devalue its currency because it had become very, very strong, it got its allies together and asked them to, you know, allow their currencies to go up so that the US dollar could devalue. And in those days, because they were very strong allies and doing a lot of business together, the other countries agreed. In today's date, that is not a question. The same situation actually appears today also, that the US dollar is very strong and they want the dollar to devalue versus other currencies, but nobody is going to give them on a plate like they did in the Plaza Accord. So the result of this was that Japan, France, UK, all these countries, they allowed their currencies to strengthen versus the USD, and yen actually shot up 50% in 2 years. So it basically, it was like a speed breaker in its export-led economy. Imagine everything is based on exports, and you allow your currency to go up 50% versus USD, which is your primary customer. Obviously, your exports are going to get hit very, very badly. To counter that export slowdown, the Bank of Japan slashed interest rates. So you can see here, post 1985, they slashed interest rates very, very rapidly, and which resulted in ultra cheap credit availability in the market. And basically, cheap money poured into assets, and they went into land, they went into stocks. The money was not going towards building new business, and massive asset speculation happened. So everybody, whether it was a individual or whether it was corporates, whether it were banks, they all got into this mania that it is a very easy game: borrow cheap yen, invest in the market, it always goes up. Borrow cheap yen, invest in the land, and it always goes up. And it became like a certainty. Imagine living through that time and for years together not seeing a dip. Obviously you will, start to believe that the market does never comes down, and that continued to happen for a long period of time. And ultimately the bubble burst, and it fell under its own weight. So post that bubble bursting, the interest rates, uh, from 1987 to 1990, interest rates also went up very rapidly from 2.5% to 6% to control this mania of asset price increase and the economy becoming very hot. So at some point of time, and in this case it was 6%, which caused a complete sort of breakdown of the system, and leveraged bets that were being made at low interest rates were no longer being able to roll over. And when the entire system is very leveraged and interest rates go up, something will break and collapse, and then the domino effect starts. So that's exactly what happened by 1990, and that exactly is what is the situation in the US today. where interest rates have very rapidly gone from quarter percent to nearly 4%. And interest rates are the key sort of narrative in today's date, that unemployment is collapsing but inflation is still up, and it's currently at 4%. No, nothing is viable in the US right now, so they have to cut interest rates again. So the same situation was existing in Japan, and that caused a banking crisis there. So a lot of banks could not roll over their loans, uh, and kept window dressing, just kick the can forward, not book losses, and so on and so forth was happening. And then basically, because of this situation, 47% was the loss in Japanese market in 6 months. Imagine 47% in 6 months. We don't have to imagine too much, because we have seen those days in Nifty, where in about 9 months we went down 65% in 2008. So that's the kind of fall that Japanese market saw post peaking, and it ultimately resulted in a cascade effect. As markets fall, margins get triggered, uh, leveraged loans against stocks get triggered, real estate starts to come down, housing loans get basically mortgage gets defaulted, more supply in the market, more supply of paper, more supply of houses. It just rolls over, and that domino effect starts till the system will find its feet. And the system did not find its feet till 1992. By the time index went from 40,000 to nearly 14 or 15,000. So almost a drop of 75% happened within just about 2 years or so. And then started the generation of stagnation, where it won't just move. Anytime the market will go just a little bit up, there would be sellers who will pounce on it, because so many are sitting with losses, and it takes a long time to digest it. Just like if you eat like a pig, your system will take a long time to digest it. It can't just come out like that. So the government and central banks tried many policies there to fix the problem. So they tried to crash the interest rate. So by 1999, they made the interest rates virtually zero. That please come and borrow, and start some activity, do some productivity. Started to do quantitative easing in early 2000s, and many such strategies were uh, deployed. And 25 years of easing and policies could not get their target inflation at 2%. It became so difficult for them to uh, deploy that money into productive assets, and there were other reasons for it, because the policies that usually work, let's say in India, if you were to reduce interest rates, suddenly the economy will start to go hot. But it was a structural change that was happening in Japan, and some deep rooted challenges were there, like aging, rapidly aging and shrinking population. So by 90s, their demographics had gone to very poor segmentation for young folks. Changing in investor behavior. So when you've had a decade of no business in investing, who will, even if it money is available at 0.5% or quarter percent, you would prefer to save it than invest it. And the productivity was slowing down, innovation was slowing down, and US and China were rising in that place. So this was the story of Japan. They have now been able to come out of it. 35 years later, the Japanese market is at a new high. There is a, certainly for the last 10 years, the market has been rising from the bottom. So the generation that, let's say, was born post 1995 or 2000 are certainly seeing fruits of investing in the markets. And this is basically a case study which you can't just dismiss it, that it happened in Japan, so it won't happen again. US is very much on path of becoming like Japan. Uh, India is very far from it. India is nowhere so important in the global roadmap yet. But one day, perhaps India will face similar issues. Perhaps Indian market can also become crazily expensive at one point of time. We are seeing that. I mean, real estate is crazy expensive in India, and stock markets are one of the most expensive markets when you compare it with other markets. And We may not be there where Japan was, but we can certainly get there. I mean, let's say, for argument's sake, there is enormous confidence in India that gets generated by global money, and India becomes like this central hotspot that if anybody is investing anywhere, some of it has to come to India. What happens if, let's say, instead of 100 billion, $500 billion come to India? What will happen if 5-10 times more money than what India can absorb comes to India? Every asset class will go up. The 100 crore apartments will become 500 crores. The 50 PE stock will become 100 PE stocks. So it is just a matter of liquidity, how it will flow to any place. We are still having fantastic demographics. Our productivity is all right. We have a high growth economy, and in investing people have a lot of confidence right now. There is no fear as such, and that is all positive for India. We've done 13% CAGR since the last 35 years. It cannot be a guarantee that we can continue to do this. Maybe there will come a phase of 5 years where we will start to do 20% CAGR. It is possible, and we will go in that hockey curve. And once we go into that hockey curve loop, doom is certain. Maybe 5 years, 10 years, 20 years, 30 years, I don't know when. But any economy that goes into that doom loop is going to suffer that doom. And I just hope and pray that we stay sane and we stay at reasonable valuation, even if it requires our market to be on sideways mode for the next 3 years. I'm rooting for that. But nothing is written like this. Folklore has started that you close your eyes, you put a sip, and you'll make money. There is no such concept that lasts forever. There is no rule of physics which says that India market has to continuously go up for the next 100 years. It may go up for the next 20 years, it may go up for the next 10 years. It will all depend upon political landscape. It will all depend upon how internationally we remain uh, competent and innovative. Lot of factors. So don't be blind to this reality that markets can really take your test at any point of time. So some lessons from Japanese journey is that risks that Japan faced are present in every economy. Uncertainties can never be ruled out, and always have a plan of action. So asset allocation, diversification, not having any blind bets that I like this company and so I'll bet my house on it. Don't be that rash in your investing journey, because what we have seen in past 5, 10, 15, 20 years may or may not happen in the next 20 years. And that is the situation that you want to avoid in your investing journey. So let us know in the comments how you like this content. You can watch this other video if you like our videos. That's also a good one. And certainly do subscribe to the channel if you haven't. And I would certainly love to see more feedback from you about our content, about our channel. Do like and share these videos, and certainly do subscribe to our channel if you haven't. Thank you. Bye.